Hello, my name is James Wigley and I'm a co-lead manager of the Gloin Fund. I'd like to tell you today about why we've got such high conviction investing in the US. The US is around 72% of our portfolio today, and we see a strong outlook for the US in the future. It's a very attractive outlook because it's driven by consistent growth over time. It's really a capital-driven business model. Utilities invest capital and they grow earnings over time, and that's why it's such a compelling future. It's really driven by the green shift today and the attractive outlook there. What I also like about US utilities is that we have a dividend yield approaching about 4% today, yet we have earnings growth of 6 to 8%. It's also got consistent dividend growth of around 6 to 8% as well. So the total shareholder return is 10 to 12%. But this is a sector which is low risk. The average beta of the US utilities sector is about 0.7. This means that you get an above market return over time on average, but it's at a lower risk than the market, so a pretty compelling outlook. Now, the reason these businesses are actually low risk is because they're regulated. So regulated businesses under US law are allowed to make a fair return on their capital as they invest in their business going forward. And so this is why it's such a compelling outlook. It's actually, the outlook's got even better recently, because recently President Biden signed into law the Inflation Reduction Act. We see this as accelerating the green shift going forward and really sets up a long period of growth for the US utilities industry, which is pretty unprecedented. So I'd like to tell you a little bit more about the Inflation Reduction Act. This is a $750 billion plan, and it's really worth breaking it down into two different stages. So as Bruno talked about earlier on, we have the green shift taking place, and we think about it in terms of wave one and wave two. So let's address wave one first. So wave one really addresses the emissions of the utility industry today. So currently, the electric power industry is about 25% of the total emissions of the US economy. This plan directly attacks those emissions, and it does it in two main formats. It basically extends the tax credits over time for solar and wind, and also storage and nuclear as well. So it's very well set up to lead to an attractive decarbonisation package here, because it makes it affordable for customers and it's also profitable for the utility companies as well. So why I'm so excited about the Wave 1 package is because it leads to a very large runway of growth for the utility industry. These tax credits will last for a minimum of 10 years, and actually, in fact, will last until the US power sector is 75% decarbonised. So industry experts actually anticipate that it will take another 20 years until we have the sector fully decarbonised. And so this really sets up unprecedented levels of growth and visibility for the sector. Now, Wave 2 is equally as exciting. So Wave 2 is attacking the other 75% of the US economy. So it does this in two main formats. Firstly, it increases and extends tax credits for electric vehicles. So as we go through the late 2020s into the 2030s, you're going to see a big ramp up in electric vehicles in the US. And this is positive for the utility industry because not only will demand for electricity increase, it will actually also lead to increased electric infrastructure in the US, which is what drives earnings for these companies. The other factor that we're really excited about as well is that this bill, there's a number of things, but this bill also increases or introduces tax credits on green hydrogen production. So green hydrogen over time will displace natural gas in not just the electric power sector, but it'll also start to address the industrial applications. So things like in the refining industry today, they use grey hydrogen. Grey hydrogen is actually produced from natural gas. But as we go through time, the refiners would also like to decarbonise their business models, and they will increasingly use green hydrogen over time. And with this tax package, the green hydrogen is already affordable and already competitive with grey hydrogen. So what's really exciting this industry is today is we're 25% of US emissions. It's going to go down by 75%, yet we're also going to attack the other 75%. And so the other 75% of emissions is basically created by the US oil companies, the ConocoPhillips, the ExxonMobils. We're going after them. The utility industry is going to take overall market share from the energy industry in the future, and that's a really exciting setup for the future. I'd like to tell you a little bit more actually about inflation in the US. And so inflation in the US is obviously on a CPI basis is kind of level with Europe at around 8 or 9%. But actually in the electricity sector and energy sector, we're seeing much higher inflation in Europe than we are in the US. And it's really because what Bruno was talking about earlier on. Europe has a big security of supply problem, and Europe has to compete with Asia to bring LNG into Europe. The US doesn't have that problem. It is abundant in natural gas. And so the US does have inflation, but it's much less onerous than it is in Europe today. Now, what I'd like to do is now tell you a bit more about the portfolio and how it's structured and how it actually will benefit from inflation and increasingly be resilient as well. So today in the US, we have, well, today 68% of the portfolio is in the US regulated companies. And regulated companies are actually poised to benefit from inflation, and it's because of the way they make their money. So the US utility industry business model is actually quite simple. These companies invest capital, they invest capex, they grow their rate base, and by law, they're allowed to earn a fair return on that rate base going forwards. So as companies invest capex, you can see that this automatically translates into higher earnings growth in the future. So not only do we have this long runway of growth in the future, which will lead to earnings growth, as we see inflation come into the model, it will also increase the capex of these businesses. So naturally, we see salaries start to increase. We see the cost of transformers increasing, just general infrastructure increasing. It's inflating capex. So as US utilities spend more capex, as it inflates, their earnings will grow faster in the future. It's also important to know about the US utility business model. It's actually quite low risk because all of the other costs in the business model, I'm talking about other salaries, fuel cost, interest cost, and any other associated costs with providing electric service is automatically passed through to the consumer when they go into rate cases. So the companies can not only benefit from higher inflation in capex, they can pass through all that other risk to consumers as well. Now, I'd like to spend a little bit of time talking about how the US utilities can actually invest in the green shift and actually make higher profits in the future. And they can do it in a sustainable fashion because it becomes affordable for consumers. So let's take the example of a real example of a green shift, where a utility company is closing down a coal plant and replacing it with a wind plant. And so if you think about a coal plant, it's very labor intensive. There's lots of people walking around and maintaining the plant. It's very expensive to maintain. There's also a lot of fuel that's required. All these costs are being passed through to the consumer, but there's zero profits on these costs for the utility company. They make all their money on the capex. Now, if you can replace that coal plant with a brand new wind farm or solar plant, what you're actually doing, you're lowering all the costs, all these fuel costs in the bill for customers, and you're replacing all these costs with a capital charge for the utility company. So the utility company will actually have, because it's a brand new plant, which is expensive and full of capex, because it's full of, the wind farm is basically full of steel, they'll get more depreciation and they'll get more profit as well. And so you're seeing the pass-through cost with zero profit on them decrease in the overall bill for customers. But the interesting cost for the utility company in terms of the depreciation is increasing. That improves their cash flow, and also their profit allocation increases as well. So it's a very sustainable transition. The US utilities will make more money, and the consumers will actually have a cleaner environment and a more affordable bill in the future. And we actually call this a steel for fuel transition. It's a key part of the green shift. And then if we look at the rest of the portfolio, so that was 68%, very well positioned to benefit from future inflation. Let's segment the rest of the portfolio, and we'll take another slice of it of 9%. And that 9% is basically coming from businesses which are regulated on a real basis. We see this primarily in the United Kingdom and in Italy. And so these companies have a rate base, and every year as inflation ticks higher, the regulator will increase the rate base for these companies. And these companies, again, they earn a fair return off a higher rate base. So you can actually see in this case that as inflation goes higher, the companies, the real regulated businesses automatically make higher profits. And many of these companies, as Bruno said, actually have a dividend which is actually linked to inflation. So you can see it directly, inflation directly links to higher dividends for shareholders as well. Now, the last main segment of the portfolio is about 15%. And that is in the businesses which are basically renewable companies, and they have long-term PPAs. So when you build a new wind farm or a solar farm, you sign a long-term contract with a counterparty. And so you build that farm and you sell all that future power. And you start with day one with a certain tariff. And as time goes by, every year as inflation picks up, that tariff will automatically increase along with the inflation. So the company's revenues will increase, but the good news is because solar and wind is essentially free energy, their costs are not increasing. So actually you'll see their profits increase as well. And that's another part of the portfolio which will actually directly benefit from inflation. And as a sense check, let's have a look at how actually US utilities historically have done in periods of higher inflation. So we've got data going back to the 1950s with US CPI, and you'll notice that actually in the 1970s there was a big spike in inflation, and through that period US utility earnings, the trajectory actually continued and was actually unaffected by these high levels of inflation. And with all the things we've been talking about today, that the regulation is very strong, the green shift is in full action, it's affordable for consumers, we see this as very well placed to continue into the future, and so we'd be relatively optimistic that the companies will be unharmed and actually benefit from inflation in the future. And now, in the context of all that, I'd like to tell you a little bit about what's going on in the utility earnings versus the rest of the market. So right now, well, as we went into 2021, you'll remember that actually earnings for the market really went up a lot. When we look at the MSCI, we saw a lot of earnings upgrades, but now we're seeing the opposite. We're seeing downgrades by analysts, and the momentum's really starting to fall off. And it's really for a couple of reasons. So, firstly, the economy is getting weaker, so the analysts are concerned about the outlook for the economy, and they're lowering earnings estimates. The other factor is, in 2021, a lot of companies benefited from inflation, but now they're seeing the opposite. Actually, the inflation is really coming to their cost, and they're unable to pass it through to consumers. So they're actually seeing declining margins. Utilities are in the fortunate position that these factors do not affect them. I've just explained to you how actually utilities are benefiting from inflation. And when we look at the data, it's also coming through. So the data shows for utility industry, actually, analysts are expecting higher earnings in the future. And because of all the drivers we've talked about today, we expect that to continue as well. So we're relatively optimistic that will happen. So, well, thank you very much for your attention today, and I enjoyed talking to you about US utilities.